Okay. Is my screen sharing there?
It is. I just need to add it to the video feed. Welcome, everybody. This is Daniel Hlin for the Alternative Investing Club. We are waiting as people are joining. Oh, I see. We're getting some good uptake right now. Okay. Good. Welcome, everybody. It's great to see you. We are going to have a club chat March 28th. I believe that is the date. And I am looking forward to that as well. So just be aware that on March 28th, we're going to switch back over to Zoom so that this is more of an interactive conversation with everybody. But if you are out there in either on StreamYard, Facebook, LinkedIn, YouTube, or Twitter, can you just put your name or put where you're from in the comments? Let us know you're here. Who are the regulars? StreamYard also doesn't let me see their usernames, which, of course, Zoom does. Yeah. But we're going to wait for just about 5 minutes. Oh, and I shouldn't be looking at the speaker chat. I should be looking at the everybody chat. Here we are. Hello, Eric, JM, Rob. Good to see you. Rob from Hillsboro. I think you all know that's where I live as well. San Diego, Portland, Oregon, Sacramento, Nestor, Atlanta, Georgia. Welcome, Nestor. All right. And Chris, where are you coming out of?
Just north of Atlanta, actually. So Nestor should reach out and we should grab a coffee sometime.
All right. Hello, Suma, Coogan, Robert, Elaine, Yi, Satish. Satish, I know I owe you some emails. And in fact, I want to let everybody know out there that if you've contacted me about the Alternative Investing Club Fund here recently, I am a little behind on my emails. So please have some patience. I will be getting around to it. There are quite a few people that have contacted me. And I am also working on right now some software for doing evaluations of private equity that I hope to make available to the club in the not too distant future. And so I'm looking forward to that as well. But I've actually been working on that a lot of this week. And evaluated a few more deals, looked at a few more speakers. I like the idea of credit or debt validation. I've come across a second debt validation group that works with student loans. They're fairly interesting. If you have a topic that you want to talk about, please, on an upcoming meeting, please put it in the chat. And over the last few weeks, we've been talking about not real estate, actually, even though that was our origin story. But we had a group come in and talk about purchasing equity in residential homes. That was actually the founder of CrowdStreet, who is on to a new venture. We also had another group that came in and talked about debt validation, where they were helping veterans and first responders to invalidate some of their health care debt and restructure it so that they could bring down the interest rate and pay it off in a 2-year window. And our club fund is actively looking at investing in that right now. They did come in as a club fund sponsor. And because this group is on top of things, we had a couple of red flags that were brought up by at least 2 individuals. And so I'm taking the next month and deep diving on the due diligence there. I want to make sure that the legal proceedings that happened because of this past incident have fully resolved and taken care of the incident. So I'm going to be doing some legal due diligence. And in fact, we'll talk about that on March 28th when we do our club discussion. I'll give a full report then. And be ready to bring in any conversations you want, because this could be on any real estate or any passive income topic. The other thing that I wanted to mention is that our club fund is doing a call for capital. If you'd like to put money into the club fund, I have a number of opportunities that we can look at here. Not only the credit validation, Courtney has reached back out to us with oil wells. I'm going to wait a little bit, I think, on Courtney, simply because I've put it into my list of best practices to, once I do a deal with somebody, wait about a year until I do another deal just to see how that deal performs. And then if it's performing, a second deal might be reasonable. But she does have upcoming oil deals, and if you're interested, I'll point you directly to her. But we will be doing some oil deals this year.
Daniel,
We also have
you mentioned the CrowdStreet founder. Was that Darren? Was Darren Powerly on?
That was Torstein.
Oh, okay, got it. I was literally this week in Salt Lake City with their ex-CIO, who also just left CrowdStreet, Ian Fermigli. Maybe some of the members or you have run into him over the years. They built an incredible platform.
Yeah, they did. They did. Let's see here. Gabrielle, let me share my screen. I know there are quite a few people there who have signed the form, and I need to follow up with you. So this is my fault. My apologies. Here is the Alternative Investing Club site. If you're interested in investing, this is not a commitment. First of all, I guess I could say that if you want to see any of our previous speakers, they're all right here. If you just click on speakers, and you can go back to any point in time. Right now, our interface is just a go back, but you can find the last 4 years or so worth of meetings here. If you're interested in the club fund, just go over here to fund and fill this form out right here. I will follow up with you. And like I said, again, I've got about 20 to 25 people that I need to follow up with. So if you're one of those people, please have patience. All right. Oh, I was going to say also, we're evaluating the airline group that came in. They buy and sell airplanes, lease them back to Delta and Alaska and other large airline carriers. They also purchase the engines and fractionalize them in a fund and put that back out to investors. So we're looking at that as well. And I've also come across an RV group that I'm seriously looking at, and I'll bring them in as a club fund speaker so that you guys can give me your feedback on them as well. And that's what this club is all about. We bring speakers in every week. We want to hear what they're doing. We want to take a look at if they're a possibility for investing, and we are together building our passive income investment portfolios. So, and you can do that on your own. You're always free to contact the speakers just on your own, and not through the club. Or if you want to get into their funds at a lower minimum investment point, the club funds minimum is 25K. We're often bringing in people that are 50, 100, 200K for minimums. So you can do it that way as well. Shout out to everybody who's here. Yeah, we've got a full house. Let's get started. Chris, welcome to the group here. This is another topic that I want to get into the fund, and we've had a couple of people talk about buying and selling businesses, and this is certainly an entire range of things. It's a beast of an area to investigate in and of itself. So I'm interested in your particular strategy. Welcome to the Alternative Investing Club. Can you tell us a little bit about yourself and let us know about your business?
Yeah,
and I'll let you put your slides up too.
All right, bear with me.
Oop, that's not it. Oh, well, that is it. All right. Got your slides there? Chris?
Yep, can you hear me?
Yes, I can hear you. Can you share your slides? Oh, no. No. Don't pause on us here. You still there, Chris?
Yeah,
there we go. There we go. Okay, wonderful.
Daniel, just to be clear, now when I'm choosing stream or share my
Well, as Chris is trying to share here, can somebody put into the chat a question or just something you want to ask? It could be about the club. It could be about investing. Go ahead and put something in the chat. I'd love to have a little bit of a conversation here while we're waiting for Chris to connect. Can you guys see me? Am I the one that's frozen? Can anybody see me? Put it in the chat if you can. Thank you, Fang. Okay, Dennis, thank you. You can see me. Looks like Chris just had to disconnect. All right. So, one thing that I want to talk about is that part of my process for finding these speakers is actually a 20 to 30-minute interview that I do live at different times throughout the day. It just depends on when the speaker books a free opening. But during the week, I'm starting to do 20 to 30-minute interviews of different people that have the potential of becoming speakers. And it looks like Chris is back. So
yeah, can you hear me, Daniel?
Chris,
I apologize. I
we
got
can
kicked
hear you.
out. And
All right. Let me
see my
finish up.
slides?
I can, and I will add it to the stage in a moment. Let me finish up the topic that I just
Okay,
launched
great.
into, though. So I wanted to let you know that I'm
Sure.
interviewing people that have the potential for being speakers. So if you're interested in 20 to 30-minute, just get to know another operator talks, I'm broadcasting them on social media and on StreamYard. I haven't been sending out the link in the email updates yet, but if you go to the LinkedIn Alternative Investing Club page, or the Facebook page, or the YouTube account, or the X account, you'll find the videos all there. So what I'm doing there is this is part of my basically lead generation process for speakers. One of the first things I do is I go and I look at their site, see what they do, make sure it's something that fits with our club, and then I invite them in. I have a pre-screening interview, and if they pass the pre-screening, then they come on to do the big Friday event. So if you're interested, there are other videos out there that are smaller, and I'm starting to do them on a more and more frequent basis, frankly, because I not only want to find the best speakers for Friday, but I also want to find the best speakers to put in the fund as well. And so I've been stepping up the number of people that I've been interviewing. All right. With that, Chris, you're not frozen, right?
Nope.
I think.
I still
All
hear
right.
you.
Good. All right. I will I'll add your slides to the stage.
Excellent. You can still hear me okay?
We can.
Awesome. And slides are added. I'm on full screen share on my side, so I lose kind of the background image. I just see my own slides. I just want to make sure you guys are okay on your side.
Hey, Chris, I need to practice this a little bit more, but I need to give my disclaimer. So Chris is coming in as an educational speaker, which means that he's just coming in and presenting his strategy here. He's not part of the club fund officially in any way yet. We're still evaluating all the people that come through. And that's to answer your question, Fang Wang. Thank you for asking that. And also, I want to let you know the Alternative Investing Club is just a forum for investors. We are not a registered investment advisor. We are neither promoting nor discouraging you from, investing with any particular operator. We are just giving you a platform so that you can hear what their strategies and what their messages are. So with that said, I'll let you talk now, Chris.
Okay. And Daniel, the slides look okay on your side?
They do.
Awesome. Well, I appreciate everybody taking the time. Sorry for the little bit of technical difficulties. My name is Chris Benson. I'm one of the partners at Blue Line Ventures. And today we're going to have a conversation around mergers and acquisitions in the lower middle market private equity space. So title of the talk will be Why Invest in Small Businesses. But what I hope for is really a discussion. I encourage you to use the chat box, and Daniel and I would love to make this as much as a conversation as we possibly can. But happy to describe, our process, what we think about, how we think about buying businesses, and see how that brings some value to you. And Daniel, just like you, I've practiced my disclaimer quite a bit. Look, we mentioned a lot of things in here. In regardless of any investment that you get involved with, just make sure you understand the legal, the tax, and the financial implications of what you're involved in. There's a lot of projections that are made in any type of investment opportunity. So always encourage you to bring your own professionals in to help you understand what those risks are. Daniel, what I thought I'd do is just a quick introduction of who Blue Line Ventures is. Like any business, it is made up of a great team of people. And I'm going to just walk through our partnership team at the Blue Line Ventures level. We all come from pretty distinct backgrounds. And I'll start with myself since I'm the one on the screen. My role at Blue Line Ventures is really on the investor relations and the capital markets side of things. My background is private equity real estate. So Daniel, a lot of the deals that you have done over the years, we helped build a pretty large self-storage platform across Southeast. I was the chief investment officer at that platform. We built it into a top 20 self-storage operator in the U.S. Just over $2 billion in management on the self-storage side of things, and resigned from that at the end of 23. And we launched Blue Line Ventures in 2024. And my role, as I said, really is the capital markets. We have two partners really that come from a strong operational background. Joe Wexler worked in operational consulting for almost 20 years all over the world. Bo McMahon owns three businesses in the Northeast, as well as a large real estate portfolio. And Paresh Mehta is our managing partner. He was a private equity-backed gastroenterologist, actually, and helped roll up almost 1,000 gastroenterologists across the Southwest, and they sold to Apollo. And then most recently, that group sold again to a group called Cardinal. And Mike Bernhardt is our corporate finance guy. He's the guy making sure that we understand how to do our accounting and really manage all things finance. But we have a great team with a lot of distinct backgrounds, and that's what brought us to our thesis. And Daniel, what Blue Line Ventures does at its core is we're trying to buy great businesses and help them grow. Now, as you know, you mentioned it in the introduction, there is a broad spectrum of businesses, both in revenues and the different types of things that they do. But ultimately, we are trying to find businesses that ostensibly have an upside, but maybe don't know how to go do that. And so in the world of private equity speak, we're trying to buy lower middle market cash flowing businesses in niche manufacturing, distribution. I would say any blue collar niche that probably is not going to be replaced by AI or Amazon. That's sort of our thesis. And just to give you guys a sense of the size of businesses, EBITDA, which is earnings before interest, taxes, depreciation, and amortization, it's just another way of demonstrating profit. We're chasing somewhere in the $1 million to $3 million range. EBITDA margins. So for every $100 they make, we would like to see at least $20 in EBITDA, above 20%, and an operating history really of 10 plus years. So these are businesses that are established. These are not startups or venture type opportunities. These are established businesses, typically in the blue collar space. Daniel, does that make sense on your side? You think good introduction as far as who Blue Line is?
Yeah, it does.
Great.
I'm curious. I'm sure your talk will go on, but I already have questions. And if anybody in the chat has questions, we've got almost 100 people in the chat now, or on the call now. If anybody here has questions, go ahead and put them in the chat. I will judiciously interrupt Chris, and we'll get the discussion going.
Please do. And if Daniel, if you want, whenever you have the question, just interrupt me. I'll be happy to.
Okay. Do you want to have a little bit of a dialogue as you go along, or you want to present?
No, please do. Let's have it as a dialogue. I'd much rather hear other people talk than just me.
That's true. All right.
So just interrupt if any questions do come up. These are just some of the examples of the companies that we currently own in the partnership. Virtual Ally is a telehealth company. That actually was a very interesting startup that one of our partners started. I know I said we bought operational businesses. This was kind of a unique situation where we partnered with a local health system. And that company has been exceptionally successful. We're still in a massive growth stage, but basically about an 8x in 2 years as far as the enterprise value of the company. And we're providing ostensibly like patient watchers into a critical care arena. So in the ICU, we have people who are watching patients to make sure they don't fall out of their bed or do stuff that they should not be doing. And then we're communicating directly with the nursing desks. We have a true blue collar type operation, a custom metal manufacturing company just outside of Charlotte, North Carolina. That's done very well. It fits right in our buy box. Kind of a mom and pop type owner who's looking to take some chips off the table. And we do custom metal works. Think like a lot of our big projects are like HVAC ducting projects, the metal that goes into the ceiling in many of the commercial projects. But our customers are calling us and saying, hey, here's what we need. And then we're custom scoping a job for them. And GI Alliance, I mentioned, that's a roll up of some gastroenterologists across the Southwest. And, Paresh, just from a track record standpoint, they've had phenomenal success along the way. So these are just some of the examples of the businesses we've been involved with to date. And I think as you think about this space, the question is why? Why do you want to look at business acquisitions as a potential deviation from, Daniel, what I understand to be mostly real estate, although it sounds like you guys are getting into some alternatives with, the airplane leasing and some of the residential equity purchases, which I almost think of as like an alternative. Is that a fair bet?
I think it is. Not a lot of people that I know in the private investment space are talking about these things, but that's the nice thing about private investment, is that the more you learn about this, the more you realize that there's creativity involved in different strategies.
Yeah, I 100% agree. There's lots of ways to make money. That's for sure. And I think I put this quote up here. If you guys listening do not know who Brad Jacobs is, and you're at all interested in the mergers and acquisition space, I would highly recommend you get his book that's called How to Make a Few $1 Billion. He did XPO Logistics, United Rentals. He's sort of a unicorn in the M&A world. And one of the folks I really love, and Dan, I think this can apply to any asset class that you guys are looking at, which is if you get the major trends right, you can make mistakes and still succeed. And I think what he's pointing to is tailwinds, right? And right now, traditional multifamily, for example, is facing some tailwinds. Everything is cyclical in the market. And so I think as investors, we're all trying to find trends that we can get in front of and allow those tailwinds to push us along. And in the business world, if you guys are interested in purchasing a business, these are the tailwinds that I think are behind you. So you may have heard the term silver tsunami. I saw in the comments that someone was interested in learning more about senior housing as a real estate asset class. And they've tried to capitalize on this silver tsunami as well. But ostensibly, more population is retiring. And over the next 30 years, we're going to have a substantial number of more retirees than we will today. So, 11,000 Americans, rough and tough, are turning 65 every day. And you'll see from 23 to 2050, we're going to have close to 30 million additional 65-year-olds. And what that means from the business side of things is there's a tremendous number of those people who own businesses in the small business aspect and do not have a transition plan. And this is the trend I think you as investors can capitalize on in this space. Is there are a number of fantastic businesses, which we'll talk through at a high level, a couple that we've experienced, that you can go, if you believe you can bring some value to, and allow them to transition to their next phase of life. Some of the data that we're talking about here is about 8 million businesses will change hands in the next 10 years. And 80% of them will just close because they don't have an option. This is not like an industrial development project where at the end they're selling this out to a private REIT. These are smaller businesses that do not necessarily have a great exit on the back end. And look, the $10 trillion certainly is a huge estimate that people are making bets on, but there's a massive transfer of wealth that's going to happen in the next decade. And we believe at Blue Line Ventures that we're going to be able to capitalize on that. And, you as investors have the same opportunities that we do. So just that's, I think, the trend and the why we think about investing in businesses. And this is the other interesting piece that I think as real estate investors, and Daniel, maybe you can answer this question for me. As a percentage of deals that the Alternative Investors Club does a year, what percentage are kind of real estate or real estate parallel?
Well, we've been trending away from real estate here recently because there's been so much slowdown in the commercial space over the last 2 years. Traditionally, until we exited Intel, we called ourselves the Intel Real Estate Club. So it was heavily focused that way.
Okay, so most investors may understand, cap rates and how real estate is valued. And this is the other interesting piece. Not only do you have this huge influx of potential supply of businesses that are looking to transition, but how they're priced right now is very much, in my opinion, undervalued relative to some other asset classes. So what you're looking at this chart on the right-hand side is lower middle market companies, which is what we're focusing on. The multiple above it is essentially 3.5 times profit. So, in private equity, traditionally, some of the more sexier asset classes in private equity, home services, technology, healthcare, trading at 11 times, publicly traded equities 20 times, the Dow Jones 26, REITs at 26 times. And so what this means is the basis of what we're buying at is substantially less than some more traditional asset classes. So you have this huge influx of supply, and the value that you're paying, or the prices that you're paying for these businesses, is much less. So I'm going to just make a quick analogy to real estate. If you buy something at 3.5 times profit, imagine that EBITDA was NOI. That means ostensibly you're buying at a 28% cap rate. And what a 28% cap rate means is if you bought a real estate project without debt, how much would it pay you on your cash every year? So if you bought a property that cost $100, it means that it would produce $28 of cash flow to you every year. In our world, those are relatively that is a pretty reasonable expectation. In the world of real estate, and Daniel can certainly speak to this, cap rates today are probably in the, let's say, 5 to 7% range. So there's this huge value opportunity where you have cash flowing businesses that you're buying at a great basis, because I don't think the market has yet identified the value here. And at least for our particular strategy, we believe this is happening because with $1 to $3 million of EBITDA, we're investing in deals that are potentially maybe too big for an individual investor, but too small for traditional institutional private equity to care. So it's not a big enough check for them to write, but these businesses are still really profitable. Daniel, does that make sense? Anything else you think we should dig into around sort of the valuation of the businesses?
Yeah, it does make sense. I wanted to ask you about your acquisition criteria, because in the first slide that you showed us with the 3 different companies, maybe it was the second slide, they're
Yes, sir.
very different companies. Very different companies. You have a health services company, metal fabricating company, and then a physician company. And so I guess my question is what are your acquisition criteria? You've mentioned kind of the size and the turnover that you want, but what about in terms of geography of the sector that they're in? How do you find the right people to take the companies that you acquire to that next level?
Yeah, it's a fantastic question. Let me take that in 2 parts, I think, Daniel. So the first part of it is what types of companies. And I would argue we're very opportunistic in the geography. We have the 5 partners we showed you. I have a partner in Austin, Texas. I have a partner in Boston, Massachusetts, and a partner in Charleston, and the 5th partner is just outside of Connecticut. So we're trying to stay geographically within 3-hour flight of any of us. So if we do have to be there on a weekly basis, it's manageable. So that puts us to kind of the Mississippi River, rough and tough. We can get to kind of Utah, Colorado if we need to, but geographically, generally southeast, southwest, east coast, mid-Atlantic, somewhere in there.
Avi's got a question here.
Oh, sure.
He actually wanted to expand on the acquisition criteria question. Whoop, that's not Avi. I'll get to you in a moment, Fang. Avi is asking, what are the goals per year in terms of acquisitions? And so I think what he's asking is how much money or how much capital are you looking to deploy, or how many companies? How do you quantify what your goals are?
Specific for Blue Line Ventures, we're saying?
Yeah.
Yeah. So Daniel, we're operating out of our first fund. We're going to raise a $25 million equity fund. We're in the midst of that right now. We believe we'll raise $25 million in equity and pair that with $25 million in debt. So we'll have about a $50 million acquisition vehicle of total enterprise value. And the goal of that will be somewhere between 5 and 8 companies. It depends on, the size of those companies. Right now, we have 1 company operating in the fund that we bought in 2024. And a second one that's under contract that will close in April. We expect the 3rd one to be under contract, hopefully next week. So generally, I would say 5 to 6 companies, we're going to raise and deploy that capital over the next 12 to 18 months. So, 5 a year feels pretty doable from an operational side of things.
Okay. And I assume
Daniel, maybe just
go,
sorry,
go ahead.
I was just going to go back to your original question of how do we find the people to help these grow? So
Yeah.
part of our particular buy box is finding partners, and I will talk about this in a little bit more in depth, but sellers who want to stay in the business. So Daniel, if I could give you a picture of the seller, it's a guy or a gal who's been there for the last 10 plus years, who's worked really hard in their business, and they've gotten it to a phenomenal level, right? If a business is profiting, let's say $2 million in EBITDA, most likely that seller is taking home a 7-figure paycheck a year, right? So they're doing really well. It usually hits some sort of ceiling on their growth. And a lot of the sellers we're trying to partner with are people that we can say, hey, let's grow together and help us do this. No one knows more about the industry than what you've just spent the last 20 years in. Help us do it with you. And so many times the seller is staying with us and we're incentivizing them to do that financially. Because in our opinion, Daniel, they're the best people that know the industry and have the relationships. And then we're trying to bring in some sophisticated operators to support them. And I'll give you some specific examples a little bit later in the slide deck, but the goal is to keep the team intact because these are profitable, successful businesses. These are not turnarounds. Does that make sense?
Makes sense. And I'll let you know we have some questions on how do you identify the business and do you use crowdfunding. But for now, let's let you go ahead in your presentation and maybe you'll come to some of these. I also want to ask you about your debt sources.
Yeah, for sure. We can absolutely to dig into all of those. So at a high level, Daniel, just on this valuation piece, where what we believe is we're buying at such a successful basis or such a strong basis because there's some inefficiencies in the market and people don't yet realize the value that is sitting in these lower middle market opportunities. I think this is the piece that you were touching on a little bit, Daniel, is what is the value add, right? And I'll use just apartments because if some of your investors are familiar with the apartment model, if we're going to do a value add apartment deal, generally we're going to go in and rehab some of the units, potentially new cabinetry, stainless steel appliances, and paint, flooring, etc., and then potentially bring rents up to market rate. Well, obviously in a business, it doesn't work exactly like that. This is how these are the pillars where we believe we can add value. And again, our goal and your goal as a potential investor in these businesses is to find ways to increase revenue and profitability. And so I think for all of the people on the Alternative Investing Club, thinking about where you can bring a business value is the key to this. Is, some of you guys may come from the technology, and so implementing technology and software to make the process, the workflows more efficient may be an incredible way to create profitability in the business. My background very much is in the sales and marketing arena. And so when we're looking at these businesses, generally none of them have any sort of customer acquisition model. When you ask the sellers, how do you acquire customers? They just laugh and say, well, I answer the phone. There isn't a acquisition strategy to go grow revenue. They've just built a reputation over years and delivering high quality work that has allowed those customers to come to them. So when we think about it as saying, all right, how can we go help grow? Sales and marketing is generally very low hanging fruit. And then Daniel, this is what you were talking about, is focusing on culture, bringing a winning culture to them, and then also surrounding them with sophisticated people is a key component. And this doesn't happen right away. I would argue that our first 90 days of acquisitions is just to sit and listen and learn about the business. And this is what I would encourage you guys to do if you're out there buying a business, is just sit. These businesses work well. Don't go in and break them. Just go in, understand what they're doing, and then understand where we can bring value and build rapport with the team so that they have that trust. So we're generally hiring executive level COO type roles to bring some sophistication around the process that the business has, because many of these mom and pop owners have spent so much time working in the business, like day to day, putting out fires, and haven't spent as much time working on the business, which is, more strategy and vision and moving chess pieces around to create the most value. So these are the three things that on our side, I think when you guys think about investing in businesses, you can think very similar, but just understand where your superpower is and where you may be able to bring value. For us, it's people, culture, sales and marketing, and implementing technology. Generally, the businesses, when we're coming into them, the technology consists of, Google Sheets and Post-it notes. I mean, there's no CRMs, there's no ERP software. It's very generally a very basic software stack that's making the business run today.
Fang has a good question here, and
go right ahead.
I was going to elaborate on her question. Actually, her question is: are the companies in the fund all in different industries? I was going to elaborate to say, do you purposely choose companies that are in different industries, or is it more opportunistic? You're getting these companies at a discounted price point, and they have good, outlooks.
I think definitely on the opportunistic side, the goal with the fund is to have a diversified offering of industries so that we don't have too much exposure in any one industry. Let's name, Daniel, the oil and gas industry, which is typically pretty volatile. Where oil and gas has a potential huge upside, the volatility in oil and gas generally has some downside swings too. And so, we wouldn't want to have all of our exposure in, oil fields in West Texas, or something specifically tied to the cost of oil. So the answer is we're opportunistic in what we're looking at. But the theme is generally the same. Blue collar, niche businesses that won't be replaced by AI or Amazon. Always, or not, at least to date, always in the B2B arena. So, these are businesses that are selling to other businesses versus, maybe a flooring company that's selling to residential homeowners. Does that make sense?
That makes sense. JB has a question. Have you liquidated or sold any of your businesses that you've acquired? If so, what was the valuation at exit? If no, is the current assumption to exit at a 3.5 based on historical exit multiples?
Yeah, so these questions, Daniel, are getting a little bit more into the specifics of our investments, which I'm happy to talk through. I can certainly dig in as much as you like. Within Blue Line Ventures, JP, no, we have not liquidated any of our companies yet. As we said, we have just started our first fund in 2024. Our underwriting, we're generally doing a sensitivity analysis with a base case, an upside case, and a downside case. In our upside case, we're saying we're going to buy at a 4 multiple and exit at a 4.5 multiple. And Daniel, I think this is an important part to dig into. Also very different than real estate, which is when you're buying a business, the valuation of the business is based on a multiple of EBITDA, at least in the space that we're in. And so when you are able to grow that EBITDA, the multiples also change. So I'll use a real estate analogy again. It would be like if you were able to grow your net operating income, and while that was happening, cap rates compressed because your NOI got bigger. Does that make sense?
Yep. So for instance, oh, go ahead.
Yeah, go ahead.
I was just going to say, for instance, if you've had a small SaaS company, for instance, I'm going to have a little bit of trouble remembering the statistics here, but basically, if you get it to a point where you've got a certain number of customers, your multiple is going to change from either a 2 or a 3 multiple to suddenly a 10 or a 15 or a 20 multiple. So you can actually, if you were relating it to real estate, you think about real estate multiples really in terms of the cap rate. So there's a certain amount of income. That means the business is valued at a certain amount. But with these types of businesses that are growing their income, there are different points at which, if they grow sufficiently enough, the evaluation method changes and that multiple becomes bigger.
You're spot on. And in the world of private equity, Daniel, that's called EBITDA arbitrage. And what some people are doing, and this can be a strategy for the people on this call as well, is what's called a roll-up. I'm sure you guys have seen it. There's been some great articles in the Wall Street Journal. Home services businesses, things like plumbing, HVAC, private equity is all over those. And what they're doing is they'll try to buy up, they'll buy one home services company for, let's say, 6 times EBITDA, but they'll buy 100 more businesses. So then they roll them all up into one entity. And now that business, that the one business traded at 6 times, but in the aggregate, they roll up that whole thing and sell it to a larger private equity group or sometimes institutional investors. And that whole thing trades at 10 times EBITDA. So as soon as you take that business that you bought at a 6 times and put it in the bucket, you've ostensibly created value. And now that EBITDA is going to trade at 10x. And this is what's much different than real estate in that if you're successful in adding value to your business, you also have the opportunity to grow the multiple it trades at. And I'll just give you some very, very rough statistics. This is very industry specific, but generally a business with zero EBITDA is not a good one. Let's say have $500,000 in EBITDA to $3 million in EBITDA is generally going to trade somewhere in the 3 to 5 times. From 4 to, let's say, 8 or 10, it's probably going to be in that 5 to 8 times. So if you're able to add value and take a business that was in 2 million and move it to 5 million, then you have the ability to trade at a much more attractive multiple.
All right. What do you have next in the slide deck? I still want to get to understanding your debt strategy.
Yeah, for sure. This is what we look for. 5 key areas at the top of our underwriting funnel, Daniel. And I would suggest for anybody looking at the M&A space, it's going to start with strong financial key performance indicators. So, we talked about some of those for us as already. We want to see operating history. We want to see an EBITDA margin. We want to see consistent growth. It's really hard to value a company when you have huge hockey stick growth and then the next year, the company ditches, 20, 30, 40% of the revenue. We like to just see, it doesn't have to be crazy growth, but generally it's bumping along consistently with, call it 3 to 10% a year growth. Those are the companies we feel like are going to be really strong. And as you look at businesses, you should be thinking the same thing. You just want to see consistency. An autonomous management team. For us, we don't want a job. Our job is to asset manage and deploy capital and help bring these companies to the next level. But the day-to-day operations need to be run by an autonomous management team. You as investors, there may be some of you guys on this call who say, hey, I want to go be the CEO of, a plumbing company in my town. Then potentially you can replace the seller and create that management team. So I think this is something to think about as well, is what do you want your role to be in the company? We also talked about this a little bit, Daniel, but we want a seller who will partner with us. And what that means is a cultural fit for sure. But also the second part is a guy or gal who says, hey, I've gotten this thing to where it is, but I want to take it to, 2x, 3x, but I don't know how. And we need some new ideas and new blood coming in and some resources, some capital to make those investments to grow. That's really who we want. And we're trying to find ways to incentivize them. And this is what I would encourage you to think about. If you keep the seller in place, how do you keep them interested in moving the business forward, both financially and in a long-term equity strategy? And then this is the one that we feel like is sort of the coup de grace. When the owners have a maniacal focus on quality, the customer relationships that they have are fantastic. So they may not be the cheapest priced service in the marketplace, but they have operating history with a quality product that customers believe in. And so even as an ownership transition changes, you want to ensure that the customers are not just there because of the seller. They have been delivering a great quality product, and that's going to continue with the new ownership that potentially you take over. So we look at a number of things, Daniel, but at the top level funnel, as we're underwriting deals on the financial side, these are some of the non-financials that we're looking at to say, hey, this is what it looks like, or this is what looks a good deal looks like for us. And Daniel, if you're okay with it, if you don't have any questions, I was going to just take you through an example of one of those deals for us. And the goal of this is to share with the investors you guys can get involved in a deal just like this. This fits all the boxes for us, but you can find something that looks just like this. So this was our first acquisition in our fund in 2024. And the business is called CNB Sign Services in Milford, Ohio. What they do is gas station sign installation. So all they do is the signage you see outside the gas station. They don't usually touch anything on the convenience store. We don't manufacture the signs. We're just doing the installation. So next time you go by a really nice gas station, like paint is all fresh and all the decals on the pumps look fantastic and the canopy fascia is all nice and clean. Generally, that facility's probably just been reimaged. And this company in Milford, Ohio has focused on just doing gas station installation. So this picture on the top is us, the 5 partners, and some of the office team on the night we closed on the business out in Ohio. And this is some of their team doing some installations. What we loved about this business was all of the things we just talked about here. They got a great team, a seller who wants to see the business grow. This is his baby. Like this is not, hey, I just want to take a check and disappear. This is his legacy and still wants to be there. And Steve has been maniacal about the quality of the product that he's put out with his customers. And just to give you a sense of some of the numbers we looked at, revenues, pretty consistent between $2 and $3 million through 21, 23. We bought it in mid 24. And what we underwrote revenue to be at the end of 24 was $3.5 million. So pretty consistent to where they finished 23. EBITDA was $800,000, which was a little less than what they finished in 2023. But we thought, look, when we come in here, we're going to add some costs. So it's probably going to be less. And our margin around 23%. And our purchase price was 4.5 times the EBITDA, right? So we bought this for just under $4 million. And so what actually happened in 2024, we came in, we helped the team with some efficiencies to allow them to expand geographically and ostensibly do more jobs than they could in 2023. And you'll see it exploded. Revenue finished at just over 5 million with an EBITDA of just under 2 million and a margin of about 12 points higher than what we underwrote, because we brought some data to the table around looking at the job costing specifically, which they had never done. It had always been kind of a gut feel thing for Steve. And what that means is with that level of profitability, based on 2024's numbers, it means we bought the business for around 2 times EBITDA. So in the context of cash flow, if we took all of the EBITDA out of the business in 2 years, we would have all of our original invested cash back. And as real estate people, including me, that was a very hard concept to understand. There's that much operational cash flow to get your equity out much quicker than at least what I experienced in the space of real estate. So this has been a home run for us. And obviously they're not all going to do, double in the first year, basically double the value, but it fit all the boxes. It was a great business, very niche-y, that the seller had built incredible relationships with his customer because of the quality of the work that they've done. And you'll see down below our current performance. This is just relative to our underwriting. We're way ahead of projections in both revenue and EBITDA, and we hope to see that continue through 2025. They started out fantastically. But Daniel, is this sort of a good representation of the type of business we're doing and what we're doing to help that growth forward?
Yeah, I have a couple of questions. The first one is anybody who's looking to sell their business, and correct me if I'm wrong, but I think that they're thinking of, at some point in the future, they might retire, not immediately, but they're thinking about the exit plan at that point. How much of the, timeline for the previous owner staying at the business do you put into your formal contract? Do you say, hey, you're going to be on for another 5 years with an option to renew? Do you go through all that? How does that work?
Yeah, it's a great question. And I hate to give you the answer of it depends, but it's going to depend on the seller, right? And what they want to do. I'll use Steve as the example just because we still have the slide up. It's this handsome gentleman in the blue shirt in the back here. So Steve is 64. He actually just turned 65, at the end of January. And what Steve wanted is a year-to-year contract, Daniel. So we had an employment agreement with him in 2024, and we have an annual employment agreement with him in 2025. And what we've done with Steve is ostensibly what Steve wants to do. He's a grinder. He'll never stop working, in my opinion. He actually lives on a golf course, and he's only played the course twice. He's lived there for like 6 years. He loves work, but what he wants to get rid of is all the day-to-day operations. All he wants to do is, I almost look at it as like a business development role. He loves talking to customers and making sure that the jobs are done the way that he would have done them if he was doing them himself. And so we've rolled Steve. We're hiring CNB Signs is the name of the company. We're hiring them a COO right now. And this COO is coming in with pretty substantial private equity experience of taking companies from 5 million in revenue to, in our cases, we're shooting for sort of 20 million in revenue in the next 5 years. And so we're going to bring in a guy who will help us build systems and processes at a sophisticated level and allow Steve to do what he loves, which is go talk to customers, which is where we want him to. So it's very dependent, but I would say, Daniel, at least for us and for your members who are listening and maybe thinking about investing, you want to understand where the seller is and what they want to do. Because if they just want to cash a check and get out, you just have to be prepared for that, to understand how are you going to replace them in the business and how much business do you lose if they walk out the door.
Mm-hmm. In terms of expanding their operations, you know, a group like this, I think, is probably going to be limited. At least their growth is going to be limited by the number of customers they have and the number of employees they can train in order to service those customers. So it's really important to roll out training programs to work on customer acquisition. Are there other kind of standard ways that you can grow a company like this?
Yeah, and I would say I'm going to add one more to your list of challenges,
Okay.
which is hiring the guys who are installing the signs.
Right.
As many construction services are aware, it is a very challenging market to go get guys who, although are making very good money, want to go do this work day after day. And that is our in this particular business, Daniel. And if your members are looking at any sort of home services or construction services, that's the challenge, is being able to recruit talent and keep them. Because as you know, blue collar trades type roles are very competitive. And so you have to be in the space and create a culture to keep these guys engaged, because they'll leave to go for another $2 an hour across the street to the electrician across the street. Does that make sense?
It does. It does. Do you have to deal with licensing issues like state licenses, or people that are come in as apprentices and then gradually move up to being journeymen? Does
Yeah,
that
that's
apply
almost
in this case?
like a union program, you mean?
Not necessarily union, but at least here in Oregon, for instance, if you buy a services a company, Oregon, from what I've been told by people in the M&A space, is probably the highest in the country in terms of regulatory procedure. Each person that works there actually needs to be licensed and go through the apprenticing process with the state. And I know that's not the same, probably not the same in Texas, but usually there's one journeyman or somebody who's been there on the crew for a long amount of time and is a veteran, and they're training the others. I guess what I'm asking is, what do you worry about in terms of state regulations for these workers?
Yeah, I think OSHA compliance, safety compliance are the bigger issues. We don't have what you're describing, at least in the state of Ohio, with the apprenticeship. It's mostly safety and OSHA training to ensure that everybody is, wearing the proper protective equipment when they head out into a job site, that they're handling tools correctly. When they're driving the forklift, they're using the safety mechanisms on the forklift, those types of things. And we have some team members who ostensibly, when a new member comes in or a new employee comes in, they're working under those team members to get that experience. And then we have the quarterly training is required by OSHA. We have a team that comes in and does that for us to make sure that we stay in compliance for those types of things.
Devka has a good question here. The business was acquired at a 4.85 EBITDA, and the project of the and the projection of total return is over 4 to 5 years. How does that align with the year-to-year contract that the seller has? So I
I'm not
guess
sure what you mean, the projected return over 4 to 5 years.
I guess what the question here is what if the seller decides, what's your contingency plan for making sure you hit your projections when, the seller decides that they don't want to renew their contract?
Yeah,
And
it's a great
and
question. So, okay.
and if you're projecting that it's going to take you several years to pull your money out, um, you know, I guess why does the seller have a year-to-year contract? Probably the answer is because that's what he wanted. But go ahead.
Yeah, you're spot on your answer. I mean, and look, if the seller left, it would be an impact, but the business is
Yeah.
still running, right? We have 35 people here that are going to work every day. And although not ideal, we would, God forbid, if something happened to Steve tomorrow, on Monday, all the employees are coming to work and we still have customers that we need to service and contracts that we need to fulfill. So it's not solely sitting on Steve's shoulders to answer this specific question. And that's why we're hiring them a COO. So their COO will ostensibly sit at the top of their org chart. Steve, the current or the previous seller, will report to that COO. The COO will report to us at the blue line level. And I think,
Okay.
great question if you're buying your own business too, is where does that current seller fit? And do you have risk if that person leaves? And we're definitely evaluating that. To answer the second part of how do we get them in a long-term contract, most of these guys are not going to do that because they don't know who we are yet either, right? Like they want to ensure that they have a good working relationship and they're not miserable. And generally employment contracts are like NFL contracts, right? They're at will. Like both parties decide if they want to be there or not. So it's not like we're locking them in. Our thesis is that we're going to be able to run a successful operating business, and there may be bumps in the road if key employees leave. But, and I hate to say this so flippantly, but although we'd love them to stay, everybody is replaceable. It's just a matter of the time that it takes to go find that person.
Yeah, it's probably a little bit different than the tech sector when there's a buyout and employees are required to stay with the new company for particular periods of time. It obviously different in these blue collar types of jobs as well. We've got 2.5 minutes left. I want to ask you
Sure.
really quickly about your debt. How much debt did you use in buying this gas station sign company? And just in general, are you using SBA loans? Are you using, outside debt sources? What do you do in terms of your debt? And then go ahead and share your contact information as well while you're doing that.
Sure. So the debt, I'm going to breeze through those slides really quickly. I know you want to be respectful of 2 minutes. Generally, 50% of the purchase price, Daniel, is what we're putting on debt. No SBA loans. It's traditional financing, generally through a bank. We'll also offer that to the seller in a seller financing note. But 50% leverage is what we've underwritten the entire fund with.
What is the
Just
bank
real quick.
usually at? What's the bank
Sorry, go
asking
ahead.
for collateral?
It depends on the business. So some of the businesses that have substantial capex, that'll be the collateral. Specifically for CNB Signs, nothing. They're taking the 30 plus years of operating history, and that's what they're underwriting to. I mean, we have trucks and trailers and equipment, but it's immaterial relative to the loan size. I think the total capex value is like just under $1 million, and we got just over $2 million in a loan. So it's basically the 30 years of operating history.
Gotcha. Okay.
Just two real quick things for people who are interested in learning more about M&A themselves. These are two great books about entrepreneurship through acquisition. These are sort of like the Rich Dad, Poor Dad in the real estate world, but in the M&A space. I'd highly recommend it. And then Daniel, these are some great websites that ostensibly think like LoopNet for real estate. You can go on and see what types of businesses are for sale in your marketplace. There's a business broker community, just like real estate. If people are excited about, going and doing this on their own, obviously, these would be some great places to start. And then if anybody has any questions, you can certainly reach out to me directly. Happy to help however I can.
I was going to say Biz Buy Sell is the big one in that group there. And I've actually read both of those books, Buy Then Build and Main Street Millionaires just came out a few months ago. Both are really good books. Really good books.
Yeah. I think a good framework for just how to think about what these business opportunities are.
Yeah. There's an Audible version of both of those books too, which tends to be how I like to consume the book. All right. Any last minute questions? We're up against the clock here. Actually, while you're all here, could you please put into the chat, thank Chris for coming in and speaking to us today. It's always interesting to hear different types of strategies. In this particular case, M&A. I think we're going to have more M&A in the future. And let me know if you like it, or if you don't, feel free to reach out to me, Daniel at alternativeinvestingclub.com. All right, blow the chat up with thank yous. And Chris, thank you very, very much for coming in. And we hope you have a great weekend.
My pleasure. I appreciate it. Thank you, Daniel. Thank you guys for listening.